Okay, let's unpack this. We're doing a deep dive focused squarely on the Q3 2025 earnings call for a major U.S. steel producer. And this was not your typical earnings event. It was really catalyst.
Exactly. I mean, what's so fascinating here is that the financial print itself was, undeniably mixed. But the narrative management delivered was entirely focused on strategic optionality, on long-term structural change.
And the market responded instantly.
Oh, instantly and decisively. The stock soared more than 20%. So for you, our mission today is pretty simple. We're going to shortcut your understanding of the results, analyze why the market ignored the shortfalls, and, dive deep into these new strategic vectors.
M&A and critical minerals.
Yeah, the things that are fundamentally reshaping this company's entire story.
Let's start with the hard numbers, because that's where I think some of the initial confusion came from. Revenue came in at $4.7 billion, which missed the street consensus of $4.9 billion.
Yeah.
And GAAP and adjusted EPS were right in line with expectations, a loss of 45 cents a share. Steel shipments landed at 4.0 million net tons.
And if you just stopped there, you'd be scratching your head about the stock move. But the market just swiftly brushed that top-line miss aside. Why?
The margin expansion.
The margin expansion. The core profitability engine was running so much better than the prior quarter. Adjusted EBITDA jumped a massive 52% quarter over quarter. It hit $143 million, up from just $94 million.
And that's all mix and cost control.
100% driven by favorable product mix and just disciplined cost control. And crucially, their liquidity is still really robust at $3.1 billion. So they have plenty of runway for these strategic moves we're about to talk about.
Okay, so let's talk about that key driver, the mix improvement. The CEO's central theme was this domestic steel demand rebound. And it was led, really emphatically, by the auto sector. Q3 was their best quarter for auto steel shipments since the first quarter of 2024.
And it's not a short-term blip, which is the important part.
Right. They've locked in new 2 to 3 year agreements with all the major OEMs. We're talking higher sales volumes, favorable pricing, all locked in through 2027 or even 2028.
So this brings up the big question. Why? Why this renewed, strengthened, long-term pricing power for domestic steel? Management was very explicit about this. They view the U.S. now as, and I'm quoting here, hostile territory for unfairly priced dumped steel imports.
Section 232 tariffs.
Exactly. The consistent application of those tariffs and just a general shift in U.S. policy is changing how OEMs source their materials. It's a powerful shift.
And you can see it in the number.
You really can. The average net selling price rose to $1,032 per net ton. That's up $17 quarter over quarter. And that improvement wasn't because of some big move in steel prices. It was entirely driven by that mix shift.
Auto shipments moving from 26% to 30% of their total sales.
That's the whole story right there.
They also spent a lot of time highlighting their capacity advantage. They have 9 automotive-grade galvanized steel plants, places like Spartan, Dearborn, Middletown. They kept saying they are ready now for the demand they see coming in 2026 and 2027.
It's all about reliability. And they had a perfect real-world example to point to. They specifically mentioned that recent major fire at a large domestic automotive aluminum mill. And this isn't just some random anecdote. Management's basically arguing that the fragility we just saw in the aluminum supply chain is pushing OEMs back to high-strength domestic steel.
So they're framing it as a structural advantage, not just a cyclical upswing.
That's it, exactly. They're saying, look, our competition just proved they can't scale reliably in this environment, but we can. It's a very powerful message.
Okay, now let's get into the segment that truly drove that 20% stock surge, the strategic optionality, the non-cyclical moves.
Yeah, the fun stuff.
First, the company disclosed they entered into a memorandum of understanding, an AI, with a major global steel producer. This producer is being advised by UBS, and management expects the outcome to be, quote, highly accretive.
A term that gets thrown around a lot.
It does. So how does this actually work? What makes it so accretive?
It's all about the scarcity value of their assets. Highly accretive means the deal would immediately boost the company's earnings per share. And here's why. Foreign steel producers are desperate to get a secure, established operational footprint inside the U.S. tariff wall.
Right, because building a new mill here is almost impossible.
It's nearly impossible. The permitting, the environmental hurdles, the capital, forget it. So this company's footprint is now a scarce gateway asset. Any foreign partner is going to pay a massive premium to access that existing capacity, and that's why the deal is so profitable for the U.S. company.
And to really underscore how important this is, they announced they're actively deprioritizing the larger asset sale process that JP Morgan was running.
Yeah, that was a huge signal.
They're saying, forget the smaller sales, this MOU is our top priority. That tells you this partnership is far more valuable.
Right. Now, separately, on the balance sheet side, they did confirm a good chunk of change. $425 million from divesting 8 non-core properties. That included the sale of their Florida FPT assets to SA Recycling.
And just to clarify for everyone, the FPT assets are what, smaller logistics facilities?
Yeah, smaller processing and logistics spots that don't really fit the big integrated steel production vision. And they said those proceeds are going straight to debt reduction.
Okay, so then we have the other truly novel vector that got investors so excited, the pivot into rare earth elements.
Yes, the REE exploration. They're refocusing their efforts at 2 domestic sites, one in Michigan and one in Minnesota, where they have geological surveys showing evidence of mineralization. And this immediately aligns the company with, U.S. critical material policy and national security.
But wait a minute, moving into rare earth sounds like a massive capital sink. It sounds completely outside their core competency of steelmaking. How did they convince the market this wouldn't just become a huge money pit?
That is the critical question, and management had a great answer. They stressed that they are a mining company at their core, long before they were a major steel producer. They understand geology, permitting, excavation.
So they're leveraging existing expertise.
Exactly. They positioned it as a diversification opportunity using land they already own, leveraging internal know-how. It's a phased, lower-risk strategy focused on high-value REEs.
Like neodymium and praseodymium.
The ones you need for magnets in EVs and defense tech. It's about capitalizing on a national strategic need, not just some sideline hobby.
And speaking of national strategic needs, we shouldn't forget that other big win they highlighted, the $400 million 5-year fixed-price contract with the Defense Logistics Agency.
The DLA contract for GOES, that's huge.
Grain-oriented electrical steel.
Yes, and that product is so vital. It's a specialized steel you need for efficient power transformers for the modern electrical grid. And because the U.S. government is stockpiling it for national security, it just underscores their unique position. They're the sole domestic producer of that material.
So it's a stable, long-term revenue stream that's completely insulated from market swings.
It's a pure structural win.
Okay, let's pivot to execution. Because all these big strategic ideas are only credible if they're also being disciplined financially.
And they absolutely are. The CFO confirmed they expect a unit cost reduction of about $50 per net ton in 2025 compared to 2024. And that isn't just wishful thinking. It's driven by efficiencies they've already implemented that should deliver something like $300 million in annual savings.
We also saw them getting aggressive on discretionary spending. They cut their full year 2025 CapEx budget to $525 million. That's way down from the original $700 million.
And SG&A too.
SG&A, yeah. Down to $550 million from an original expectation of $625 million.
So this creates a much lower, much more resilient cost base for when demand really normalizes.
But maybe the biggest operational tailwind is just around the corner, the expiration of that onerous slab supply contract.
Ugh, contract. It required them to buy imported slabs, and it valued those slabs using this totally irrelevant Brazilian index. It created a costly price floor that was completely disconnected from their actual U.S. input costs, and it just hammered their margins.
So the expiration date, December 9th, is a really big deal.
It's a huge deal. That date allows them to bring all that slab production back in-house using their own much cheaper inputs. It's an immediate, quantifiable margin boost just waiting to happen.
And financially, they bought themselves some serious flexibility. They refinanced their 2027 bonds, pushing the next major maturity all the way out to March 2029.
That's a lot of breathing room. The only real dark spot they mentioned was their Canadian operations.
Right, about 9% of total sales.
And management was not happy. They called it an absurd 65% import penetration, and they basically blamed the Canadian government for not acting against dump steel.
So let's put it all together. What does this mean for you, the investor, looking at this?
Well, the market clearly priced the option value of these strategic moves, the MOU and the rare earth sway, over the current quarter's P&L. It's a signal of strong belief in management's vision and the scarcity of their U.S. assets in this new global trade environment.
Okay, so for follow-through, what should people be watching?
3 things. First, the formalization of the MOU, We need details on the structure, capital needs, the synergy math, the devil's in the details,
Das hemmt.
concrete milestones on the rare earth side. We need timelines for technical studies for permitting at those Michigan and Minnesota sites.
And third, I assume, is just watching the auto contracts.
Exactly. Monitor the execution, the full flow through of those new 2026 contracts to realize pricing and margins.
All right, time for our favorite segment, where we remind you this is strictly for informational purposes, not a recommendation to buy or sell anything.
Not financial advice.
But if we were to pitch a speculative long-term play based purely on the themes from this call, what's the outrageous but plausible idea?
Okay, hear me out. The pitch is highly leveraged, long-dated, out-of-the-money call option.
Huff behold.
It's a bet not on the slow cyclical rebound of steel, but on a massive immediate catalyst. You are betting on the formalized announcement of a highly favorable structure for that MOU within the next 6 months.
So you're betting on the deal getting done.
You're betting on the deal getting done and being as good as management hinted. The market has priced in some optimism, sure, but a confirmed, highly accretive deal would create an even larger scarcity premium almost instantly. The thesis is simple. Their U.S. footprint is a gateway asset, and the value of that gateway have been permanently reset higher. You're treating the stock less like a cyclical steel play and more like an M&A optionality vehicle.
So, to recap the high points of the call, it was a mixed quarter on paper, but it cemented a huge strategic shift. You've got the long-term auto contracts, aggressive cost cuts, the valuable DLA deal, and of course, the two massive catalysts, the MOU and the Rare Earth Initiative.
And that leaves you with the final question. Given that management believes U.S. industrial policy has permanently changed the rules of the game, are we watching a legacy steel company transform into a diversified, essential national security supplier? That structural shift is really the narrative the market bought into this quarter.
And remember, that last segment is strictly not financial advice. Do your own research, especially on those big catalysts. We'll definitely be watching those MOU headlines to see if the market's aggressive bet pays off.